Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at EarningsBeats.com, and this is Trading Places Live. It's Thursday, February 2nd, 2023, and I'm pre-recording this Trading Places Live for just a little bit later this morning. Currently, we see futures mixed. We have the Dow futures down 125 points, S&P 500 futures up 19, NASDAQ futures up 178 points, up about 1.44%. So even though the Dow's down 125, NAS is up 177, 178, the percentage moves are quite different. Dow down about 1/3%, NASDAQ up nearly 1.5%. Crude oil futures down about 47 cents, just below $76 a barrel. And the U.S. 10-year Treasury yield, after a big drop yesterday, down another 1.3 basis points. We're down to 3.385. Of course, the recent low was 3.37. So we'll see whether or not that holds. But we are down, challenging a pretty important support level there. Let's go ahead and go through today's agenda. It's going to be packed with a lot of information. I'll try to get through all this as quickly as I can. But we'll start off with the daily market recap, talking technically. Then we'll go into ChartList, sentiment, earnings spotlight, and then wrap up with the 3 you must see. Going to start off over at Earnings Beats, however. If you go to earningsbeats.com, scroll down, we have a free newsletter. Just want to make sure everybody's aware. You can subscribe for free, no credit card required. Right here, just put in your name. Don't need your time, just a name and email address. And it's a 3 times a week newsletter, Mondays, Wednesdays, and Fridays, usually out by 8:30 in the morning. Also in that newsletter will be a link to bring you into our Monday and Wednesday shows over at Earnings Beats. I also do Trading Places Live over at Earnings Beats on Mondays and Wednesdays. So you can check that out. But just sign up. We'd love to have you. All of our free webinars, we reach out to this Earnings Beats Digest list, invite everybody. So there are multiple reasons to think about subscription there. Again, no credit card required, and you can unsubscribe at any time. All right, looking at the market summary for yesterday, I just pulled it up in a little different manner today. Actually, we can look at the table view. Then we can see what was working, what was not working. You can see the NASDAQ yesterday was up 2%. S&P 500 up 1%. Look at where the Dow is. The Dow's all the way back here flat. Remember when the Dow and the S&P were leading the NASDAQ badly in the fourth quarter? Well, that's reversed. And now the NASDAQ is playing catch up, and it's doing it again with futures today. But all in all, really good day yesterday. So what happened yesterday? Well, if you were under a rock, the Fed released its latest policy statement at 2 o'clock in the afternoon yesterday. We initially went lower, and then we soared into the close. And that's kind of a hallmark of the Fed announcement. We tend to see a lot of volatility. So a lot of ups and downs right afterwards. You get a lot of head fakes. You don't know really what to trust. But by the end of the day, it was pretty clear. Market had a huge rally. In the afternoon, we saw the NASDAQ breakout. We saw the S&P 500 breakout, and we'll talk about that in just a bit. But overall, really, really good action yesterday. Looking at some of the key indices, actually, I'll switch this back so we have the best on top. Check out transports. I don't know if you've been following transports at all, but if we just pull up a quick chart here, we broke out. Well, it looks like we closed at about the highest level in about 9 months on the transportation average. Now, for those who believe we're heading for a recession, I can tell you that the stock market and big money completely disagrees with you. Let me say that again. If you believe we're going to have a deep recession, any kind of a recession really, but especially a deep recession, if you think things are going to really get bad, Wall Street completely disagrees with you. We'll look at a few charts throughout the session, but that's one of them right there. If we're getting ready to head into a really bad recession, things are going to get ugly. Why in the heck would transports be moving to a 9-month high? And I'll show you a little bit later. Truckers are at a 52-week high. Home builders, home construction, 52-week high. Why? Why is money going into those areas? Home construction? A big recession? Truckers? Think about it. Makes no sense. You could look across many industries. Pull up restaurants. Restaurants doing extremely well. Anyhow, you can see NASDAQ 100 was up 2.16%. Mid caps had a good day. Small caps had a good day. Even the widely diversified Wilshire 5000 up more than 1% yesterday. Looking at the sectors, what was leading? Technology, consumer discretionary, and communication services. When you make a breakout like we did yesterday, and you've got these three groups leading you, you're being led properly. These are the three major ETFs that I want to see performing well. Consumer staples had a pretty good day. So both consumer groups were in the top 4. Recession? I don't know. Energy, obviously not very good yesterday. Crude oil was dropping. And as a result, I think energy, the supplies were, the inventory was much higher in the U.S. yesterday. And that was certainly one reason for the drop in crude oil prices. And that in turn led to a very weak energy sector. Looking at some of the industry groups, semis exploding. Transports exploding. Disk drives. How about retailers? Yep, there's that recession again. Retailers leading a breakout. That's usually what you'll see heading into a recession. Little sarcasm there. And go all the way down here to the bottom, and that's where you start seeing a lot of the commodity-related stuff. Commodities really didn't perform as well. They lagged yesterday, especially in the energy area. Internationally, I'll tell you, I'm going to do a show here pretty soon on the international stocks because I actually think many areas around the globe look better than the U.S. And I'm a bull in the U.S., but I think some of the other areas look even better. And we don't concentrate our efforts on international stocks and so forth at Earnings Beach. You can only do so much. And I'm certainly not an expert in all these various countries with all the geopolitical, issues and governments and, laws, regarding trading and you can't be on top of every country around the world. So I leave that to others who are much more versed in those areas or in international policies and international markets and so forth. But I can tell you, based on the numbers, strictly looking at the countries and how their various indexes are performing, many of them are breaking long-term downtrend lines versus the S&P 500. They are worth including in your portfolio. Maybe that'll be a good one to take a look at and see what some of the best international areas look like. Don't have time to do that today. But anyway, this was just a really quick look. You can see the 10-year Treasury yield note down 13 basis points to 3.39%. And here was the commodities down here. So we had a couple that were up a little bit higher than the S&P 500, but for the most part, it was really ugly in commodities. I have mixed feelings on commodities going forward. I think the economy will strengthen, which in turn will drive prices higher. I just don't think that the commodities outperform the S&P 500. If I'm right about the S&P 500, we'll have to see, but I just don't think you're going to see leadership there longer term. And I know that goes against some of my colleagues here at StockCharts that write a lot, and I have tremendous respect for everybody. But we all have our own opinions, and that's just mine. I think they'll do okay. I'm not looking for a lot of leadership in commodities. All right, let's keep moving on. 10-year Treasury yield. So this is where we closed yesterday, 3.39%. And again, today, right now, we're down, just a little bit, half of a basis point, 3.39 3, actually just dropped to 3.391. There's your 3.37 support area right there. Do we fall below that? I don't know. I don't know. My guess is yes. I think we're downtrending, so I think eventually we break. But I'd watch that area and then also watch 390 to the upside. That's your range for now. And we're on the verge of breaking beneath the support. As far as economic reports go, I usually like to talk about those when I'm talking about the yield. Of course, now the Fed's behind us, and the Fed did what everybody was expecting, basically. They raised a quarter basis point. I think we'll probably get one more because they're still talking tough. Yet they definitely acknowledged that inflation is slowing, that they're seeing a path of disinflation. And I'm just paraphrasing a little bit from Fed Chairman Powell. But we are seeing disinflation. Well, I've been talking about disinflation. I'm more worried about deflation, but right now the stock market seems to be okay. And if the stock market's okay, then I'm okay. But the threat is still out there. And I think if the Fed overdoes it on these rate hikes, I think that would be bad news. Fortunately, the rhetoric toned down a little bit this month. I think the stock market took some really bullish cues from it, and that's why we saw a nice rally into the close. Rest of this week, today, 3 big earnings reports after the close today. Apple, Amazon, Google, and then we've got non-farm payrolls tomorrow morning. So talk about a 1-2 gut punch between this evening and tomorrow morning. What we have today in the market could be completely different than what we have tomorrow. Although I love the breakout, don't get me wrong. I think this breakout's for real. I've been saying we've had a lot of bullish signals for many months, and now we're getting price action to confirm it. I love what's happening, but there is a lot of information that could drive the market in either direction tomorrow. All right, so let's move on to talking technically. So we've got the S&P 500 here, and you can see the breakout above. Remember, I wanted to get through 4,100 over here, 4,110 right there. We closed at 4,119, up more than 1%, closing at the highest level since that infamous Jackson Hole speech by Powell, the more pain ahead speech. So nice to see that. I would expect that the S&P kind of has a clear shot up to about 4,200. That's where all that big selling really began with the Jackson Hole speech. If we get through that, only thing left is 4,300. And honestly, if we negotiate 4,300, bears, it'll be time to give it up. I mean, I think it's time to give it up. I think it's been time to give it up. I said back here in June that there was much, much more risk to being short than there was to being long. Called bottom. Late September, we went down, put in a double bottom. I said, here's your second chance. We traded a total of 5 days in October beneath the 2 support levels that I gave. 5 days. We've been up every other day since June, except for 5 trading days. I mean, you now have the weekly S&P PPO going up over the 0 line. So you're getting a bullish crossover there. We're now bouncing off the 20, which is starting to come back up, looking at a golden cross potentially. It would be the first time since the death cross back here in April. The problem I have following trends and strictly buying and selling my portfolio based on price action is that by the time you get the death cross and you get the key breakdowns, you're already down 10, 12%. And by the time you get the signals to the upside off the bottom, you're already up 10, 12, maybe 15%. What good did that do you? Get out somewhere in here or over here and then get back in at the same price? You didn't save anything, right? Why not listen to the signals in January? where I said the risk of being long was too great. Get out there and get in here. That's a much better plan, I think. Call me crazy. Anyhow, S&P looking much better. The weekly chart, again, bullish crossover looks good. We got the 20 coming up from underneath the 50. We've now taken out that November high. Really, the only thing left technically that I could see much argument over is taking out 4,300. And we'll see. I think it happens probably sooner than a lot of folks think. Anyway, NASDAQ 100 also breaking out to a multi-month high. We have to go all the way back to the Jackson Hole speech right there. And actually, this was 2 weeks after the Jackson Hole speech. That was actually the August PPI came out that day. So we went back and eclipsed every high since that day. Still got a little bit of overhead resistance, though, coming up from September 12th at 12,750. That's another 400 points. Who knows? That might be taken out today or within a couple of days, especially if those earnings reports tonight are better than expected. Let's move on and talk about chart lists. So the first chart list I want to show you, every month, we do a lot of research at Earnings Beats. It's not just about buy this, sell that. Number one, we're not registered investment advisors. And I think if you have a service that's based on saying buy this, sell that, and you're not a registered investment advisor, you're really, it's kind of a gray area. So we put out setups and talk about the educational side of it, what we like, what we don't like. But ultimately, you have to make the call. But the thing we do really well at Earnings Beats, in my opinion, is our research and the things we provide our members. This is our seasonality chart list. We send this out. We sent it out at the beginning of January. Might have been on December 31st, 30th. I don't remember exactly when it went out, but it was for the month of January. This is the 1 month returns on all the stocks that were on this list. Now, the stock market, the S&P 500, I think went up 6.7%. So somewhere right in here. But look at how well all these seasonality stocks did. Tesla, and the way we set this up, is you'll see it name in order. So 001 is Netflix, and the reason it's 001 is it had the highest January average return, 15.9% average. It went up another 22% this year. It goes up 70% of January's. And I also put the earnings date in here, January 19th after the market closes. So just looking at this one stock, you know that it's a really strong January stock, and you know when earnings are coming up. So if you want to bail before earnings, or if you want to hold into earnings, whatever, you can do so. You also can see if some of them are February earnings reports, and then you don't have to worry so much about earnings during the month. Now, do they all work? Of course not. Here's Dexcom, 7.6% average January return. It goes up 76% of January's. It was down 5%. Didn't work. And XPI in the semi space, 22%. Meta was up 27%, and that's before today. We're going to talk about Meta in a little bit. They reported earnings last night. Stock is exploding this morning. Tesla, there's your 47%. Average is 6.3% in January. Only goes up 58% of the time. I like these stocks that have high percentages and also go up a lot. Like JD, 6.5%, but it's gone up 88% of January's. Went up a little bit better than the S&P 500, but it made it, another up year for JD. Anyway, so it's in order. You can kind of see the percentages dropping. So it's in order by January percentage, average January return. But again, you can look at this on a percentage basis. And I mean, these stocks by and large went up pretty darn well. Dexcom and then Enphase, renewable energy stock, really got hit. These two were the only down stocks out of the whole group. The other chart list that I wanted to talk about was our short squeeze chart list. Want to see, so this is a year to date. So this is since the beginning of January. This is the return of our short squeeze stocks that we gave out to members. 308%, 207%, 186%, 102%. I wrote about Wayfair a couple weeks ago. Still looks good to me. Yesterday, Carvana absolutely exploded, and it was up pretty good in pre-market as well. But if you look at something like Carvana, look at the move it's making. Look at the volume. There's your average volume. If you want a short squeeze, you need big volume. Well, Carvana's got that. And the problem is now anybody who is shorted, especially if you shorted late in November or especially December, you are getting crushed right now with unlimited risk to the upside. And that makes you emotional, makes you want to have to trade these stocks and get out of them to just stop the pain. And if you ignored yesterday, remember how when the market was getting hit, if you're on the bull side, sometimes you don't even want to look at your statement. When it comes in, you don't even want to look at stocks. Well, imagine being on the other side of that. You shorted a stock at $3, $4, $5, and it goes up 33% yesterday to 13, and you don't even want to look at it. You're like, it's a horrible company. I'm just going to wait this out. And then you wake up the next day to Carvana, and it's up another 30% pre-market, $17. What if you just did 1,000 shares short at 3? When it got to 10, you were down $7,000. It jumps up 3 yesterday. It's another $3,000. Pre-market, you're down another $4,000. Shorting is great when you're driving the price down, but when you get these squeezes, and the thing that's really interesting about the short squeeze list, what we do is we put them in name, or we put them in order here by percentage, short percentage of float. So Carvana, 58%. When you look at the stock, you have to understand that the movement to the downside is exacerbated by all these shorts. I'm not saying it's not real. There's obviously selling, but a lot of what's causing this move to the downside is people borrowing shares from other people that own the stock and then selling those borrowed shares to the tune of 58% of all the outstanding and not outstanding, but all of the shares available in the market to trade. That's what the float is. 58% of those shares are short. So when you start seeing breakouts, you have technicians that buy the stock, but then you have shorts to the tune of 58% of float that has to start buying. The short squeeze list that we have, it is a printing press when short squeezes start to happen. It's literally a printing press for money. But many of them, I mean, for months, you just watch them. You don't do anything. When they're downtrending, you don't get in and say, well, it's heavy short interest, I'm going to get in. Nobody's being coerced into buying when it's going down. Shorts are making money. Why are they going to cover? It's this. And when Wayfair broke, I mean, look at the sideways consolidation for a while. Support here at about 43, resistance here at about 43. We broke out, we went back, hit the 20-day, and then boom. And it has been a nightmare for shorts on Wayfair. Another one that, we're watching, and we talked about it, our live trading class last Friday, was Beyond Meat, which we saw make a huge move higher, came back down, went back yesterday, hit the 20-day, and it could be maybe thinking about going higher. I haven't looked this morning. No, it's up 3% to 1750. I mean, if it gets back up above this level, you could see that volume really start to soar again. Here's another one. I'll give you another one in the 3 you must see at the very end, but I want to get into sentiment real quick because I think sentiment is turning. Here's that 253-day moving average. It's starting to roll over. All I can tell you is that historically, when it rolls over and starts to go lower, the market goes up. Rolls over, starts to go lower, market goes up. Same thing here, goes up. Same thing here, goes up. I believe we're rolling over, and I think we're going to have a big move to the upside probably over the next couple years. I think 50% is very possible. I would even say somewhat likely. I think 40 to 50% over the next 2 years. I think we'll be well over 5,000 in 2 years. 5,500, 6,000 maybe. I think it's very reasonable. Now, here, the thing is, this number is skewed. And the reason it's skewed is that we've had all of these crazy high equity-only put-call readings in the last 3 months. The highest we ever had was back during the financial crisis, 1.35%. During the pandemic, when everybody was scared out of their mind, didn't know what was happening, and we lost 35% on the S&P in 4 weeks. The highest we ever got during that panic was 1.28. So you're telling me in the fourth quarter, when the market is doing really well, the S&P did extremely well, that the equity-only put-call ratio is going to be at 240, 182, 160? No. I went back and did some research. And if you look, these are the daily readings back in November and December. These were the days, many of them were Wednesdays for whatever reason. But anyway, I went back in and looked intraday, and there were massive amounts of puts going in over maybe an hour period, because they give you every half-hour reading. And it would just be normal until about 11 or 12 o'clock in the morning. And then, boom, all of a sudden, 500,000 equity puts would hit. The next hour, 600,000 equity puts would hit versus maybe 100,000 calls. So the ratio during that hour would be 5 to 1 or 6 to 1. And it sent these ratios, it skewed everything. So what I did is I went back and set up a user-defined index for the CPCE, and I adjusted these to what a more normal calculation would have been had we ignored those huge spikes, because that was not retail trading. That was the professional group. That was the big money that were taking some big positions on some of the large cap tech names for whatever reason, hedging, whatever. But when we eliminated those, this is what you would get. When I eliminated all of my, or not eliminated, but changed those November and December readings, look at what the 253-day moving average is doing now. We are finally rolling over. Been waiting and waiting and waiting for this. Of course, had other signs that the market was bottoming, but this is one more confirmation. Very important to follow that. Anyhow, let's move on to earnings real quick. Just a couple of big ones. Meta, let's get the latest here. Make sure I'm giving you the latest numbers. Up 19%. And then I'll give you another one that was really big last night. Align Technology up $49, 17%. Earnings being rewarded again, especially now in this risk-on type of environment. And the last thing I wanted to show you was the 3 you must see. Wanted to start off with the home construction group, 52-week high. Just wanted to point that out. How about the truckers, transportation area? 52-week high, huge move yesterday. And then finally, one more short squeeze stock. Watch this one. If it gets through about 580, 590, that'll put all the shorts for the last 4 months on notice. Look for big volume, though. You got to see the volume pick up. That's it for me. Have a great day, everybody. Happy trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.